To their credit, regulators have begun to be somewhat more open-minded about how to think about risk. When an investor opens an account with a financial advisor, they're required to complete a document called a new client application form, which generally centers around how much they're willing to allocate to cash, bonds, and stocks. The account opening document used to monitor suitability had previously centered around these basic asset allocation targets. That all changed at the beginning of 2023 when new regulations known as the client-focused reforms were enacted, giving primacy to risk tolerance and risk capacity. Where there had once been a percentage allocation targeted for cash, bonds, and stocks, there are now percentage allocations for low, medium, and high-risk investments. As such, there's now a continuum that any given product or security might fall into when being rated for investor suitability as a component of an overall portfolio. That's an important step forward, although it may be a bit discomforting for people who have spent the past generation or two looking at risk the old way. If there was one thing that 2022 taught us, it's that a traditional portfolio diversified between stocks and bonds can no longer be relied upon in managing a client's overall risk. Specifically, in the first 9 months of 2022, both stocks and bonds were down by about 15%. And by the time the year was over, most traditional 60 portfolios ended up down by double digits. Part of the challenge is that many asset class correlations are increasing. Diversification still works, but in a globalized world, it works less well than it used to. Yet another part of that challenge is that most vehicles used by most people have average risk-return characteristics. In a world where most of your options involve taking medium amounts of risk, it becomes more difficult to offer true customization that fits client circumstances and potential market outcomes. It's perfectly fine to have a view on both portfolio construction and macro-level market outlooks, but discipline, open-mindedness, and preparedness are needed when encountering turbulent markets. It's more purposeful to think of managing risk overall. Regulators are coming to recognize this and are trying to capture more robust and meaningful attributes when accounts are opened to provide more accurate oversight. Risk comes in many shapes and sizes. For example, it is widely accepted that the trade-off for more liquidity is often lower returns with more volatility. That said, not all clients are able to withstand the risk of having less liquidity. Whether or not to take that risk is a conscious decision that involves trade-offs. Rather than set asset allocation targets, the personal finance industry is moving to a risk budget approach where only certain allocations can be put into high or medium risk products while remaining agnostic about the asset classes those products might fall under. For instance, a traditional balanced portfolio might be 60% stocks and 40% bonds, but a more contemporary balanced portfolio might be 50% stocks, 30% bonds, and 20% alternatives. And a portfolio constructed using the risk parameters set out using the new parameters might be 30% high and 20% medium high, 40% medium, and 10% medium low. Individual products are given a discrete risk rating and slotted into appropriate categories. Getting products and risk ratings to align is the new normal in monitoring suitability. All told, the new approach allows for greater flexibility regarding portfolio construction. The new way removes the focus on strategic asset allocation, even though, as many people know, studies have shown that asset allocation is a primary determinant of both risk and return. It's a brave new world. Risk and return are being assessed as considerations that are separate from asset classes. Not everyone will like this, but I believe it improves the ability for advisors and portfolio managers to piece together combinations that offer superior risk-adjusted returns. The related development is a new focus on both risk tolerance and risk capacity. This may well prove to be an even bigger challenge in the short term. Studies have shown that people purport to have a strong tolerance for risk if markets are relatively stable. Thus, many people are ill-equipped to accurately assess their own tolerance and capacity for risk, especially if they've never encountered it in a meaningful way in their lifetime. The industry is moving forward. Progress is being made, and we should all be happy about that.